Other than that, Nifty Metal and Nifty Pharma Index, that also is doing well. Nifty Metal Index, that started the day on a red, but now it has seen a little bit of a buying, and it is up about 0.6%. Other than that, we can see Nifty Auto, Nifty Bank, all of them not doing well. India Wix, that has also spiked up. It is given about like 1%. It's started off with 2% up move, but right now it's just moderated and it's up about 1%. Broader markets, they're seeing a cut. Of course, they're down mid cap and small cap indices. They're down about 0.1%. But let's quickly get on board with the fundamental guest on the show. We have market expert Aishwarya Dadish of Fident Asset Management. Aishwarya, good morning. So good to have you on the show.
Good morning to all the viewers.
Aishwarya, the Fed has cut interest rates by another 25 basis points. And the Powell has also indicated that he has not ruled out the possibility of a December rate cut as well. But the RBI, they have hinted that the inflation in October could exceed. So when do you expect the RBI to embark on the rate cut path?
I believe obviously we are out of these two big events. One was the Trump election outcome, US election outcome, where Trump came out with a victorious feat. And obviously we saw yesterday about the US Fed outcome. I believe the whole equation has changed now with regard to how things will play out for the global economy and the global market going ahead. Obviously, Fed went ahead and did 25 bips cut yesterday, but the next move, which is in December, I believe they will watch out any change in the policy which possibly this new administration bring into, and the fear about rise in your 10-year yield, the rise because of the fiscal deficit expansion, the clarity about cut has definitely taken a backseat after this regime is what I'm trying to indicate here. Now, it's very interesting to see historically when Trump came last time in 2017, your that time both CPI inflation as well as your 10-year yield was close to 2%. Now, when he enters his regime this time, it is hovering around 4.25 CPI and almost 4.3 of US 10-year yield. And on top of it, if you look at last time when the US deficit and the US debt as a percent of GDP, US deficit was close to 3%. Today it is almost close to minus 6.5%. And when I look at a GDP, which is US debt as a percent of GDP was almost 103. It is almost close to kissing around 120. So it will be very important to watch because I believe the maneuverability with Trump to play around with expansions is limited. And the whole thesis about fear in the market, I believe it is more than warranted. So possibly they will take a middle way somewhere around, and even Fed on top of it will look out how the changes will happen. And that's why they have taken out the inflation comfort tagline from their statement yesterday. So I believe there would be like there was 90% probability of another cut in December. It has gone down to 50-60 as we speak. And when we see more data coming ahead, I believe we will have more clarity. Coming back home, RBI definitely will try to be in a wait and a watch mode. They will try to see how things will move ahead with regard to regulation, with regard to tariff, because we have already seen that dollar index has strengthened. We are seeing that yield is hardened over there. So there will always be a risk of, imported inflation in the country. And we are already seeing, if you see a CPI inflation is a 7-8 month high. So I believe RBI will still remain in the wait and watch mode. And we definitely rule out any cut by RBI in this calendar year at least. Whatever will happen, possibly will happen in the early part of the next calendar year, and that too, it will remain very shallow, is what we believe.
Okay, all right. So a delayed rate cut is possible from the RBI. But Aishwarya, what could be the next catalyst for the markets? Because we are done with the US presidential elections. We are done waiting for the FOMC outcome as well. But nothing really created a trigger and an up move in the market. So what could be the next catalyst that we can be looking out for?
Obviously, we have, as I said, we are out of these two big events, all right? And we are in the middle of this quarterly season, which has not all that great, right? If you look at the trend that we have picked up in this market, the trend that we have picked up in this quarterly season has not been great, right? Apart from banking and to an extent, I think there's some disturbance there. Yeah, apart from banking, there is some sectors here, there, metals, cements, construction materials have all seen a very muted set of numbers. And on top of it, on account of all of this, we actually seen cut in Nifty earnings. So if you really see the month of October, when Nifty has gone down 6%, right, it has been accentuated because of FII selling, no doubt about it. But a large part of it is also to do with the cut in the earning estimates of EPS of Nifty. So both for FY25 and FY26, we for the broader part, the FY26 EPS cut is close to 6 to 8% after the number that we have witnessed so far. And market has more or less mirrored that, cut in the EPS through the price depreciation of 6% there. Second most important thing, as you talked about the events, I believe the closely watched event will be the FI's outcomes, because we saw almost the highest number of flows happened in the month of October, close to it. The secondary selling was to the tune of almost 11.5 or more, little more than that $1 billion. And I believe the trend is continuing in the month of November so far. So I think the only thing which people will like to see what the trend change happens, especially after the Trump outcome of election. And at FIDEN, we reasonably believe that this trend of FI selling will continue because all of a sudden US is looking more attractive because of the all excitement about the taxation cuts and the expansionary mode that they will take. I believe a lot of money will start moving back to US. And we have seen that dollar has appreciated, we have seen the yield has hardened. It doesn't bode very well for the emerging markets. So, and on top of it, we are seeing that China is spending its balance sheet. Possibly they will announce little close to $1.7 trillion of I would say support to the whole economy. Then it will become more difficult for India, given that more of the passive outflows will happen out of India. So possibly the FI flow is just was not for a month. We believe it will continue, and market will try to take cues that whether this can turn around, which to us looks very unlikely as of now. Even that, I think the magnitude will definitely go down, but the trend is not reversing, at least for this calendar. So we will have to stay with that. And apart from that, there are no big positive expectation as you're expecting on markets. They are more to do with any other geopolitical risk if that picks up, or if the inflation data deteriorates further from here, then and that will be which will be impacting the market adversely. So we are in a tough time, if I may say so. So the next 1 month, things are not looking all that rosy.
Okay, Aishwarya. Aishwarya, I just have a two-part question here that you mentioned about. We will be seeing aggressive outflows because US markets have turned attractive. So how much of a correction do you expect for the Indian markets to occur at this point? And the second is that when do you expect the FIIs to make a comeback to India?
So I think that's a great question. And we're doing some study on FI flows and its impact on the market. And what came out very interestingly is that when you look at the last 20 years of data of when the FI appreciation led, FI buying led appreciation and FI selling led appreciation when happens, the correlation coefficient is very high on the month when it happens. So the correlation coefficient was almost 0.58 for the month when the FIs either buy India or when they sell India. The kind of impact that they have on the market is higher. But when we do that study for the next 1 month, next 3 months, next 6 months, and the next 1 year, the correlation coefficient falls sharply to close to 0.5 bips or 0.8 bips. So this data tells very clearly that FI is not ruling the Indian market. And historically, the case was 15 years back, 20 years back, the trend was there. But right now, the last 5, 10 years, or even in this calendar year, obviously when they sell, there will be an impact. But it doesn't say much about the forthcoming market movement in the coming month or so. The correlation coefficient is very, very small. And second, when you determine the coefficient of determination, that is the R square. I don't want to sound very pedantic here, but this is a very, very important data. It clearly says that the R square ratio of FI selling and the market performance is almost 30%, 0.3, which basically says that even in a month when market CFI is a lot of selling which has happened, say in the month of October, when market went down 6%, Nifty, the 30% was on account of FI selling. 70% was on account of other reasons. And for us, this time the reason was the cut in the earnings because of a very big set of numbers by quarter numbers that we have seen. So to summarize what I'm trying to tell you here is that FI is not taking the shots in the market. The trend of FI selling, more or less, as I said, will continue. But DI buying, the way most of these large institutions are sitting up on cash, markets froth has been taken care of. Majority of the indices have gone down between 5 to 8%, apart from the micro cap. Major of the stocks has gone down between 20 to 40%. So that value proposition is coming back into the system. And with the intensity of domestic, the financialization of saving and the domesticization of stock market by the investors will continue. We believe that this trend will get within weakened over the next couple of months. In spite of FI selling, we will not see much impact on the market is what I'm trying to tell you. So that is what we believe at Fit India also.
Okay, okay. 70% you mentioned that was because of other reasons and because of a dismal second quarter performance as well. But how does the upcoming quarters look like for the India Inc?
Obviously, we are almost out. I believe this is one of the weakest quarter that we have witnessed in many, at least 2 to 3 years, if I look at this data. And I can tell you, this is a very mixed trend, where we have seen, as I said, the construction materials and FMCGs and automobiles have done really bad on performances. But if I look at businesses with a more rural focus, if I look at BFSI, if I look at IT, if I look at some pharma names, have done relatively well. Even if you look at the numbers of, Trent yesterday, or possibly Page Industries or Indian Hotels, which reported the numbers, it tells you a very, very different story that all that is not broken yet, So that is what it is. So obviously, I believe that the expectations of double-digit growth, which we witnessed over the last 4 years, has taken a beating. But given the revival in rural side, the revival in deposit led in the financial system, things are not all that bad, is what I'm trying to tell you. So we might not do 14-15%. We will still be happy with 10 to 10% growth on EPS for that is for the next 1.5 years for the market. And since the valuation have taken de-rating from that perspective, things are looking on risk reward perspective, I would say optimistically attractive, if I may use that word. But some revival on ITSS space, even after the after the Trump outcome of election, can, because it has a higher weightage in Nifty, can play around fine. BFSI continue to do well, which is almost like 40% of the Nifty pack, should help money growth over the next, say, 2 to 3 quarters. But we don't expect any sharp recovery, at least for the next 2 years. So 8, 9%, 10% year-on-year growth is what one should be happy at this juncture.
Okay. Ashwini, we saw a dismal Q2, but majority of the experts, they have said that the financials are their favorite bet. So does it stand the same for yours as well?
So if financials is one area where the risk reward is most favorable, right? And when we look at the numbers this quarter, I think this is one sector which is actually holding up the indices return or the market EPS growth per se, right? And both private as well as PSU, so far SBI is yet to report, but majority of the other PSU have reported very decent set of numbers. Second most important thing which was lacking in the financial space was a slightly lesser growth of deposit. And I think first time we have seen that deposit growth has actually outpaced credit growth. So, stability is coming back into the system. So I would say BFSI is more or less is a hiding space for the next 3 to 6 months when we are not seeing too much happening in other sectors per se. Second, the biggest concern on credit cost and asset quality has not really been an issue apart from MFI and some unsecured personal loan segment. So we can obviously avoid those kind of BFSI or NBFCSS space. But large private banks, PSU banks, I believe they provide a lot of comfort from value propositions. I think private banks are trading at almost 2.2, 2.3 times price to book 1 year forward, which is almost like 10% lower than the long-term average. And that holds also for NBFCs. One have to be selective with NBFCs. Obviously, if you see gold loan, because of the gold prices, we are seeing very strong growth. But MFIs and possibly some of the vehicle finance to be ignored. MGIs, housing finance, those are the areas which we believe will continue to grow well going ahead. Uh, Private banks, I believe, is an area which will be where we will see massive buying for institutions in the coming times. Now, obviously, there is some concern on NIM contraction because most of these private banks are trying to go and garner deposit at a higher cost of funds, which will possibly have a pressure on spread and on NIM eventually. And on the time, if you see an interest rate cut by RBI, that will further put pressure. But that way, any banks which has a very strong liability asset franchise will be able to manage it fast. And second thing is to look at the credit cost. So probably business banks which has a more standard procedure, stronger procedures on asset liability management as well as the crediting underwriting practices should be the part of the portfolio. So we at Fident are very optimistic on private banks and we are overweight majorly on BFSI and ITS as we speak.
Okay, all right, Aishwarya. Aishwarya, just one last question before we let you go. But what are the other themes that you like apart from financials? We've had a Q2, subdued Q2 performance. But where do you find that those undervalued themes are there, and there is a little bit of a conviction in earnings as well?
Apart from private banks where we believe there is value proposition in favor, other things which we like are basically platform plays. We like exchanges, we like RTA agents, we like more of this financial platform plays. But if I look at from value propositions, majority of them are, I would believe, not very comfortable on valuations. They are trading between 40-45 times price to earning, but the growth part is very, very strong. So, those propositions, on exchanges or RT agents is what can see a much higher growth there. But the risk reward in the BFSI space is only favorable for banks. For NBFCs, only segment which we like is housing finance. I believe that is where you can see majority of the players are trading in the range of 2.5 times, 2.7 times price to book, where the growth is in upward of 15-20%. That segment is where when investors can go and allocate money apart from the private banks over there. Second, last but most important point is that we believe this trend will continue for the next 6 to 8 months, 9 months, when we see other sectors not catching up. So when say chemicals sectors start catching up, or say IT sectors start catching up, a lot of the smart money will start moving from BFSI to places like segments like this. So that will possibly the play we will try to do in coming times. But right now, because of this visibility on the market is tough, I believe capital should be deployed in BFSI per se to protect capital as well as have a healthy growth, which is the only sector which we are witnessing growth so far.
Okay, BFSI, chemical, some of the plays that you're watching out for. But all right, Aishwarya, with that we have to let you go. Thank you so much for your time. We hope that we connect with you soon as well.
Thank you. Thank you so much.
All right, let's take a quick check of the markets. Sensex and Nifty, both of them have recovered from their day's lows. Sensex is up about 100 points, while Nifty is up about 46 points, still flat in the green, but still above that 24,200 mark. Nifty IT index, that is the standout performer of today, doing well in today's trading session. We can see the top gainers in the technology names continue to be TCS, Infosys, HCL Tech, Wipro and LTI Mindtree. Apart from that, broader markets, that has seen a bit of a recovery. Mid-cap indices in flat in the green, but small-cap indices still not doing well. Top gainers dominate the top technology names. Apart from that, top losers continue to be Trent, down about 2% in today's trading session. Despite a stronger Q2, it still is disappointed that it was not in line with the street estimates as well. BPCL, Coal India, Shriram Finance, Tata Motors, all of them not doing well in today's trade. But we'll see how it pans out. But with that, we have come to an end of this edition of the Opening Bell. Don't forget to tune in at 3:30 p.m. for Closing Bell. We will be discussing about how the market has developed, what the stocks are in focus. Until then, signing off, stay tuned to moneycontrol.com for all the news updates and market insights.